year we get to do a couple of these podcasts, Jamie, where there's new policy, new rules, new incentives around lending for real estate in Canada. And the newest, increasing the, or CMHC has come out with a few different new increases. So the first one being the cap on insured mortgages. So an insured mortgage is any, if you have less than 20% down payment, the maximum purchase price, if you are an insured mortgage, is moving from $1 million to $1.5 million in December. Number two, increasing the amortization, so the length of time your mortgage lasts, for first-time buyers from 25 to 30 years on all property types. So if you're buying resale or new construction, increasing amortization of your mortgage from 25 to 30 years. And three, on new construction only for any purchaser, don't need to be a first-time buyer, increasing the amortization for insured mortgages, so less than 20% down, from 25 to 30 years. Are these changes significant? Are they going to make a difference? And why are they coming into play?
I mean, it's demand stimulus in a time where they need it.
For sure.
I mean, let's talk about the $1 to $1.5 million increase first.
The practicality of it is a bit bizarre, right?
It's interesting. It's to me, it's such a insignificant part of the population in transactions. It's such a minor stake, but it probably is more significant when you look at pre-sale condos. You know, if you look at the towers that have been selling out in, New West, Pier West, Boza, downtown Vancouver, there's a lot of $1 million two bedrooms or $1.2 million two bedrooms and $1.4 million two bedrooms. And, you know, those pre-sales, people bought them 3 years ago at prices higher than today. I mean, this essentially gives developers or buyers of new developments more certainty of getting funded to purchase their place.
Yeah.
I think that's really what stands out to me. I mean, how many, I believe if you're under 20% down payment and you're buying a place just under 1.5 million, I think you need an income of around $250,000 or $300,000 to qualify for that.
So I heard people talking about this on a podcast, and they have not finalized the down payment rules yet for this increase to $1.5 million. So kind of stay tuned. But assuming it's the same as today you need a minimum of 5% down up to $500,000, and then a minimum of 10% down on the amount from $500,000 to $1 million. So if we assume that continues, the 10% down continues from $500,000 to 1.5 now. If you're purchasing a place for $1.499 million, the minimum down payment goes from $300K down to $125,000. So your mortgage now is $1.375. How many people can debt service a $1.375 million mortgage that have $125,000 down? Not many, because the combined household income was about $320K to qualify for a mortgage like that, assuming you have zero other debt, no car loans, no anything else.
To me, it's just such an insignificant part of the population.
Yeah.
You know, like even if you have 10% down going from 1 to 1.5, usually those people aren't making that much money to qualify for that. You know, like, most people aren't making $300,000. People that are making $300,000 a year or buying $1.5 million places often are selling something, have equity, or usually putting more than 20% down.
Yeah.
Doesn't mean everybody is. It just opens up another option for high income, potentially first-time buyers, maybe, just high-income people that don't want to put a lot of their own equity or money into equity. I don't see this having a major impact at all. I think maybe it could have an impact on certain new developments that have a lot of products that are, finishing in this price range. But when was the last time you had a client buy over $1 million with less than 20% down?
Well,
that was not allowed. That was not allowed. That's a loaded question. Or call it a $900,000 place. Typically most people that are getting up there are. Oftentimes I find the ones that are less than 20% down are first-time buyers, and usually that's probably under $700,000.
Yeah. Majority for sure. My guess is that number 1 and 3. So number 1 is increasing insured amounts up from $1 million to 1.5. Number 3 is increasing the amortization from 25 to 30 years on new construction for anyone, not only first-time buyers. My guess is this is a way to encourage people and encourage developers to keep building so that there's more people that can technically afford. I mean, small percentage, but there's more people that can afford to buy these presale units. And with the, crisis is a big word, but it seems like crisis of new construction in the Greater Toronto area right now. A lot of people are just not closing on condos. One, because they either can't qualify for mortgages, or because the market values of those places are significantly less than their contract price, that they're just walking away from deposits. So my guess is these two things are, one, trying to get people to actually close on these units and give them more financing options, but two, encourage developers to continue developing over the next few years, where maybe the situation or the environment for new construction is bleak in some markets.
So congratulations. You might have the ability to close on your Toronto or Vancouver condo, but you're probably underwater the moment that happens, and you're already underwater going into it.
There's one building, I don't know if you remember this presale. I think it sold around the same time as Pier West, which was 2018, which is when condo prices were very high, if not peak timing. Butterfly downtown, West Group. They were getting $3,000 a foot, and they're coming up for completion, I think, in the next few months. When if those start reselling, are they down to $2,000 a foot, $2,200 a foot? It's definitely nowhere near $3,000.
No, I think you're right. I think it's probably the lower. Those are huge hits, and I don't know if all those buyers. Do you think those buyers? There's probably a lot of foreign buyers in that mix too. Is that
I would guess there was quite a few foreign buyers. I would guess there was a lot what speculation with something like that.
I did not have any clients buy into that for $3,000 a foot, Denny.
No.
We're more of the Pier West type. That's what we're going to be dealing with. But yeah, you're absolutely right. And I think that is going to be more in the headlines. It's already been talked about now. And when you look at the cycle, a lot of these new condo developments that sold at the peak are closing this year or next. And this is when we're going to have the peak headlines of people walking away from deposits. And even if you just so you're clear, you can't just walk away from a deposit and think you're free and clear. The developer can go after you for damages as well if they resell the unit for less. That was a threat that Ani did back in the day in 2008, 2009, when there were people, when that market crash happened. Different price points, much lower. That was a $400,000 two-bedroom back then. We're talking about much higher prices today. But it's going to be ugly. And I think that the lesson learned is, even when these speculation pre-sales were happening, there were lineups around the corner. Everyone was jumping at them. It didn't matter what the prices were. They wouldn't even really make prices, transparent. They would raise the prices throughout the day of the launch. The first buyers in the morning might get a little price and they'd up at $10,000. You could get away with so much when it was that frothy to sell a new construction development. And now they're not even launching them because the ones that have been launched are just sitting. And so I think that the new development market will come back, but I'd be surprised if it comes back strong next year. It's probably going to take another year. And right now, I think the story is going to be people that are closing on properties that for more than what they're worth. And not everyone. I will say, I still feel like when I look at some of our clients, like that boutique, smaller East Van development is not, way underwater. There's it's usually the ones that you can usually tell. It's the one that sold for 30-40% more than everything else around it. Whereas, the wood frame East Van building might be more of a 15% premium. But even then, there's more demand for it from locals. There's not as much demand from 3,000 a square foot buildings in the Butterfly or $1.3 million two bedrooms overlooking the Fraser River in New West.
We'll get back on track quickly, but I want to ask you this quick question. How many years, because that cycle will come around again, but how many years until we see that pre-sale environment like we saw at Pier West? So Pier West, I remember going to a lunch with the developer. They invited 15 or 20 realtors who sell lots in New West. And they had no idea what they were going to price these units at yet. And they just wanted our reactions. So this guy's talking about the project and he's like, we're thinking in the range of $900 a foot. And at that time, resale, which was maybe a similar type property, was selling for $750, $775 a foot. And so that is a reasonable, normal, little bit of a jump. That's what, 15% roughly, to have a project that is completing in 5 or 6 years. And my gut reaction to that was, yeah, that sounds about right. I think people would buy things at $900 a foot. And then within 5 minutes, he's like, yeah, we're leaning more towards $1,000 a foot. And then people's reactions were a little different. They were like, oh yeah, okay, well that's like really pushing the envelope for New West. We've never seen anything get near that price point. I mean, is that actually going to be worth that when they complete? Who knows? And obviously you could tell from that this person, I remember pretty clearly, he thought that our reaction wasn't negative enough to push the envelope a little more. And then literally a week later, they come out, and in that week, they opened their presentation center. They had 3,800 people fill out request forms for 600 units, 3,800. And then they say lottery, but it's completely rigged. New development, new construction pre-sales. It's a little bit grimy. I get a call and they say, okay, great. You have 2 units. They're X price. And there was over $1,100 a foot. And it's not like they were super high up in the building. They were around the middle of the building. So they, I guess, chose to start the building at the bottom at like a little over $1,000 a foot and then go up from there.
Oh, I mean, in that moment, that was, unprecedented time in pre-sales. And they will come back that way eventually. I think that the draw with pre-sales is when they were so hot like that, interest rates were low.
Yeah.
Prices were climbing. There was a lot of success stories of people making money on pre-sales. And you just get caught up into getting a unit as opposed to the details of the deposit structure and price.
Yeah.
And right now, I think the key message is, I think if you're buying a pre-sale right now, deposit structure, price, and developer reputation are more important than ever. There's risks with developers. There's, in my opinion, it's not a market to put 20% down for a deposit structure. And there are exceptions to that. And there was times where you could buy them for 5 or 10% deposit structures. Now, these are bank requirements that developers need to meet in order to fund the development, but that's changed a lot.
I went to a couple pre-sale developments yesterday in Langley, new development townhouses. Both of them are 5% deposits.
5%, but they have probably a quicker closing?
Yeah, one of them is like early next year, and then the other one is spring to summer next year. So they're like within 12 months.
So that's, but that's still good. I mean, that's better than before. It's 20% deposits came out of nowhere, and 5% used to be the norm a long time ago.
There was one I remember going to, I can't remember which development it was, but it was 25. That was the highest I've seen.
Yeah. When we're talking about pre-sales right now, it seems like it's reasonably priced if it's, call it 15% above market value. That's what it's, that's kind of how much pre-sales has picked up over. Even though today you wouldn't really be successful at selling them at 15% above market value at this moment, but it as a realtor, when a client's going into a place, you look at, it's closing in 4 years, 15% deposit structure. Yeah, it's going to be, this 2-bedroom is going to be $100,000 more than a comparable existing 2-bedroom.
Yeah.
And you accept that. But 15 years ago, 10 years ago, like maybe not 10 years ago, but closer to 15, I can recall new project launches being very close to resale prices. Victoria Hill in New West, Elliott Street, when they launched, the prices were just a hair above resale, and you had the same and lower deposit structure. So, there have been, I'd like to say developers have reaped the rewards of increasing their deposit structures and raising the price over the last few years, but really, it's not like their profit margins are necessarily increasing. Prices go up, construction costs go up. It's just that the overall, everything's got more expensive and everything's less favorable to buy new construction than it was before.
Yeah.
That being said, there will be a moment where, my thought would be 2026. If you're looking at a new construction project that's finishing in 2030 and pre-sales are just starting to pick up again and get back on track, there probably is a great opportunity to get market gain with buying pre-sales again. It's just right now, in the next year, we're probably going to have more negative stories than positive ones.
Yeah.
But if you give up now and you don't get back on the saddle, the next story is going to be positive ones.
Yeah.
I want to talk just briefly about amortization, because I think that one's moving the ticker the most out of the CMHC announcement, going from 25 years to 30 years.
Yeah, I definitely want to spend more time on this one because number 1 and 3, like I said, I think is geared more towards like people closing on pre-sales and new construction projects moving forward. But number 2, is one of the best policy changes I've seen probably in my career.
Well,
that I'm more optimistic about, at least.
Let's acknowledge the history of amortizations before we get that, because I think your career began 2014 when it was 25 years. 2014. So if your career began in 2005, in 2006, there was amortizations of 35 and 40 years.
Remember that.
And I can recall a client buying with a 40-year amortization with 0% down.
Zero, yeah.
And they put a deposit down and got their deposit back at closing. You know, so you had a 5% deposit on the purchase, but you got it back at closing because you had a 40-year, 100% mortgage. Those days are done. That is demand stimulus right there. That's what caused that 2008 crash, was 35, 40-year amortizations. In 2008, they reduced the amortization to max it out at 35 years. So those 40 years went away, and it was hard 35 in 2008. 2011, they reduced it to 30 year. So they brought it from 35 to 30 in 2011. In 2012, they brought it down to 25. And it's been at 25 this whole time until this first-time buyer announcement this year to increase it from 25 to 30. So it has been at a 25-year amortization for 12 years. And yeah, that would be your career, Denny. You've seen 25 years this whole time. But I can remember the feeling when it went from 40 to 25 over a period of, well, call it 35 to 25 over a period of 4 years. And I thought, geez, look at what that's doing to the mortgage payment. Because you would see these 35-year amortization mortgage payments at, you know, lower rates, and then it gets jumped up. Like it was shocking at the time. But I mean, today's mortgage payments are astronomically higher than what they were then. So it's just, we're in this bizarro world where everyone's paying so much more for their mortgage payment. And I mean, for some, it's a struggle that can't be sustained. For other people, they're starting to adapt to this much of their income going to a mortgage payment. And when rates go down and when amortizations go up, I think the curiosity I'm going to have is if more people are just going to be okay to keep a higher mortgage payment and buy a bigger place next time. And if this high mortgage payment trend is going to continue, or if people are going to get more conservative after this and pull out. I think it might be a combo thereof, but I think there's going to be a lot of people that get used to these higher mortgage payments and just start saying, okay, well, rates are down. I can buy a bigger place now.
Yeah. I do really like this policy. I like that it gives first-time buyers a better chance of getting into market earlier in their working careers, let's say, versus like some of the previous policies were just bananas to me. Like the one where the government is going to give you 10% and own 10% of your home. That just seems silly. I didn't have one client.
The first time buyer incentive was shared equity.
It's so silly.
We don't
right?
have anyone looking at that.
Really, when you're purchasing a home, you're purchasing a monthly payment essentially, right? And this allows first-time home buyers, younger people earlier in their careers, to get into housing earlier by extending the payments over 30 years. And I think it's a really good idea.
I agree. I actually think when you look at our prices today and our mortgage payments today, that 30-year amortizations should be for everybody, and first-time buyers should have a 35-year amortization. Like, it's just where and that may come. And we still have the stress test. The stress test was introduced, I think, finalized in 2018. Yeah. And 25-year amortizations with a mortgage stress test is far more conservative than 2006 40-year amortizations with no stress test, or a different, zero down and everything that was going on then. So our prices are high, and when you look at the cost of a new condo, the cost to build a new home with all the engineering that's involved today that wasn't around 20 years ago, the engineering requirements, the energy requirements, the cost per foot. I mean, everything's gone significantly up. And 25-year mortgage amortizations just don't reflect a big city market prices like Vancouver. I think we need longer amortizations. That would be my 2 cents anyway.
Jamie also did some math on what that change looks like for a first-time buyer, increasing your amortization on a monthly payment from 25 to 30 years. I think this is really interesting to kind of put some context behind how this actually really will help people with getting into housing and monthly costs.
Yeah, I mean, this is a first-time buyer that has a hefty mortgage example.
Sure.
So let's call it the $1 million mortgage first-time buyer. But the $1 million mortgage first-time buyer, if you have going from 25 years to 30 years, you're saving about $500 a month, or I think $480, give or take, depending on the rate and the details. But that's, call it $6,000 a year.
Yeah.
On a Yeah, that's
So
significant.
and rough percentage wise, if you are thinking about becoming a first time home buyer and you are wanting to take a $500,000 mortgage, it roughly reduces your payment by about 8%.
9%.
Yeah.
So if you're, call it a $5,500 payment goes down to $5,000.
Yeah.
Give or take. Yeah.
So if you are half that and you're getting a $500,000 mortgage, let's say your payment roughly is $2,900, it probably drops your payment close to $300 a month, $275 a month.
All in all, I'd say kudos for the amortization, even though it's first-time buyers only. I will say first-time buyers, if the products they're purchasing get busier, it does trickle up in the market. So even though it is mainly for first-time buyers, it could benefit higher-end listings and as it trickles up. That's definitely a phenomenon we see in this market. But I think it's going to start showing its colors next year, not this year.
Mm-hmm. First-time buyers, we are in really good buying conditions right now. So if this is sparking your interest to get into real estate and purchase your first home, I would say do it sooner than later. Start having the conversations with someone like James Garbutt or Denny Dumas if you are thinking of purchasing your first home, because I firmly believe in 12 months from now, the buying conditions are not going to be the same as they are today. And buying conditions for the types of homes that you would be buying right now are very buyer friendly. There's more availability, there's more room to negotiate, there's more time to do due diligence, and those are all good things for first-time home buyers who have never been through this process before.
100%. I think you nailed it, Denny.
Beautiful.
Let's leave it at that.